Hello, can you see my screen, right? So I will start the revision just before I will brief you the what we have discussed at the our lecture series. Thereafter, we'll move to your question, right? So basically, the our discussion was on the corporate taxation. So in the examination context, it's very important you to understand the computation of a tax liability of a company. It's basically resident company, right? We learn the source of income as I mentioned in the lecture series also. So we are not work out the in or the person's tax liability. We work out the first assessable income from sources, which is for anybody, any person, and thereafter we'll work out the taxable income, right? So as you know that under section 2, it says if a person, any person who is having a taxable income or the final withholding payment, receipt of final withholding payment is liable for Sri Lanka tax. So therefore, we work out the assessable income. So in the context of the corporate taxation, which is relevant to the company, basically, assessable income mainly comprises from business. So therefore, in the examination context, you will be provided a details of the profit and loss of a company, which is prepared as per the LFRS, IFRS or whatever thing. So that is general accepted accounting principles and standards. So we use the same financial statement for the preparation of assessable income from business of a company, provided that there are some adjustments that need to be done. So in the questions, basically, there's an introductory paragraph, right? In the introductory paragraph, it says what type of activities business is doing. Hello, can anybody tell me whether you can hear me and you can see my screen, please?
Yes, sir.
Right. So therefore, that's why that the information is important for your context is to understand the nature of the activities done by the company. So reason is, you know, the under the main deduction is says some expenditure which is incurred in the production of income, when capital nature expenditure is allowable. So you to decide whether some expenditure is incurred for the production is necessary to generate income. So you should have some sort of understanding what the company is doing. So that will be there. And thereafter the stated capital, that means issued share capital reserve question. Basically, it's very important when we are having finance cost. There is a limitation of deductible amounts. So therefore, it is important. Then we use the, as I mentioned, profit before tax. Remember, profit before tax reason is income tax expenditure is not a deductible expenditure under section 10. General deduction, it says it is not deductible. Therefore, we are using the profit before tax, right? So an important point is, you know, that in the comprehensive income statement, the P&L, basically it is about the income and the expenditure. Difference between the income and expenditure we recognize as profit or loss. So therefore, in the income side, we have to check whether is there any other source of income, right? Other source of income. So maybe assessable income from investment that we need to work out under separately. Therefore, intention is to first compute the assessable income from business. Therefore, if any other source of income, we have to remove. Right? Simple example, if any dividend income, basically if the company is, say, doing a manufacturing company, so if they have make any investment in shares, they would have received dividend. So therefore, dividend is investment because they are keeping additional money. That money is investing, right? Thereafter, in the income side, we have to check if there any tax adjusting item. So we need to separately deal with those type of things. Example, disposal of profit or loss on depreciable asset used in the business. So it is part and parcel of assessable income because realization gain or the loss on a depreciable asset is part and parcel of the assessable income from business. Therefore, but as for the tax point of view, we have to work out separately that part. So therefore, we have to recognize this type of thing, right? So thereafter, the expenditure side, basically why we need to check these things. I mean, hello, in my point, any expenditure, I mean, we can categorize under the administration, marketing, or distribution expenditure, finance, or other whatever expenditure, right? So because comprehensive income statement shows the difference between the income and expenditure, or the gains and the expenditure. So for the tax point of view, the format is not important. I mean, for the financial reporting purpose, we are using format. So as per that one, we are breaking up that expenditure, right? It could be a direct expenditure, could be indirect expenditure, whatever expenditure, which is for the tax point of view, we have to check only 2 points, which is whether it is allowable expenditure or not, or the disallowable expenditure. So yeah, especially tax law says under section 10, that is general deduction, it says some sort of expenditure are, even it is incurred for the production of income, it is not a deductible, right? When we have worked out the business income, it is not deductible. Simple example, provision. Bad debt, amortization, depreciation, it says provision of transfer to the reserve, or the any making a reserve for the future losses. Basically, that is provision, right? So these are not is deductible expenditure, right? And gratuity provision, and also entertainment nature expenditure, penalty, fine charges, etc., incurred in the in case of the breach of law, so written law. So that type of expenditure is not deductible. Therefore, you properly get an understanding on the application of section 10, that is main deduction we have discussed. Under that, I can say there are 3 parts. One thing is that there is this in the section, it says these type of particular expenditure that precisely mention what sort of expenditure which are not allowable or the disallowable expenditure, as well as thereafter it says the expenditure which required to deduct AIT, advance income tax, or the withholding tax, but fail to deduct but not remitted to the commissioner general. Such expenditure is not a deductible expenditure, right? So simple example, I could say we are making a royalty payment for the use of the intellectual property rights. So it is required when we are running a business, say a trademark or the some type of patent right to copyright, whatever thing. So if we are supposed to deduct withholding tax at 14%, if we fail to deduct that thing, we cannot deduct that particular expenditure, even it is directly involved in generating profit for the production of income. But if we fail to deduct with relevant withholding tax, or if we have already deducted but we have not remitted, so it is not a deductible expenditure, right? And it is, and also cash related payment. If any expenditure or cost of asset, which in all of the series of payment or the single payment is more than 500,000 LKR. If we if you have made not using either bank transfer or account pay check or debit or credit card, so it on the pay order, that type of expenditure is not deductible expenditure, as well as it shall not be considered as a cost of the asset. Say I am purchasing an asset for my business, say printer or the photocopy machine, which is more than 500,000. I have paid in cash. So that is actually capital nature expenditure, but acquisition of asset which used in the production of income, it is entitled for capital allowances. But for that purpose, even I cannot claim capital allowances because I am not using the mode of payment which is prescribed by the Act. So that is also coming under section 10. So I mean the give concentration of these things so that they are disallowable expenditure, right? So we did one question or the two question on that we discussed this type of thing. And thereafter the section 11 is directly says capital expenditure we cannot deduct. And also it says any expenditure not incurred for the year and also not incurred to product producing or the production of income. It is not deductible. Example, CSR expenditure, corporate social responsibility expenditure, donation, that type of thing is not deductible expenditure. So it says not connected to the or the not incurred in the production of income during the year, right? So that type of expenditure you have to separately identify and that need to be disregard or the disallowed. So remember in the comprehensive income statement shows the profit and loss. That means after deducting those type of expenditure. That's the reason where or the why we have add back those expenditure or put it to the plus side in the plus and minus statement, right? Thereafter, special adjustment required these type of things, especially interest cost. So it's section under section 12, it says the disallowable interest cost asset. How is set up that when the establish that basis? It says borrowed money should be used for the purchase of an asset. An asset should be used during the year for the production of income. If it is the case, such interest cost is a deductible expenditure, right? And all the any other borrowing that is incurred in the production of income. So used to production of income, that type of interest cost we can deduct. That is allowable interest cost. Apparently, because we work out the tax liability of a company, so there's a maximum limitation of deductibility of the finance cost. So in that case, it says in case of the company, 4 times of the issued share capital and reserve. Remember, in our examination context, question is related to the corporate taxation, which is relevant to the company. So in that, in such situation, this section is applicable. So it says 4 times of issued share capital and reserve. That is the year-end balance we are using. Reserve shall not include revaluation of assets. Revaluation assets, revaluation reserves, we have to remove. So other resources we can use, right? Any other thing. So any excess amount we can carry forward to the next 6 years and we can claim subject to the same limitation. So that is relevant to the interest cost or the finance cost, which is incurred. First thing is you have to first work out what the allowable finance cost or we can consider total finance cost, interest cost on that allowable thing. So the disallowable part we have to remove. Thereafter allowable interest cost. So that is limited to this one, right? That is coming under the section 8. It says that maximum amount that can be deductible. So next important point is repair improvement cost of a depreciable asset used in the business. Remember that depreciable asset should be used in the business. So if it is the case, repair cost we can deduct. There is no restriction on that, right? Without any limitation, we can deduct in case of the repair cost. But improvement cost, there is a maximum limitation, maximum cap, or the maximum amount that can be deducted for a year. It's a building and structure 5% of the written value of the assets at the end of the previous year. So first we have to determine what is the tax written down at the previous year. On that, in case of the building and structure, 5% is the maximum amount what we can deduct as improvement cost. So improvement cost is cost which enhance the value of the asset, right? So in the case of the other class of asset, 20% of the written down value, tax written down of the previous year, so we can deduct. Then balance thing, we have to add it to the depreciation basis at the end of this year. Well, that means after claiming capital allowances, we can add, right? So that is relevant to repair and improvement costs. Remember, repair cost in case of the repair which is used for the business, there is no limitation. But in case of the improvement cost, that is more or less is capital nature expenditure. So such expenditure, there's a maximum cap that we can deduct, right? So research and development expenditure, we can deduct incurred in the production of income or whatever research we are doing. In that case, even they are capital nature or not, we can deduct. Marketing and communication expenditure, that is also in case of the business, related to the business, we can deduct even capital nature expenditure, right? And thereafter, the important point is capital allowances, which is coming to section 16 and balancing allowance. So it says how many years we can claim capital allowances, right? Building permanent nature structures. So over a period of 20 years, straight line basis, we can claim. So the assets which are owned and used in the production of income, the use in the business, right? So remember, depreciable assets should be depreciable assets. That's why we are not claiming capital allowances for lands, right? Other assets over a period of 5 years, other class of assets, right? Intangible assets, useful lifetime or 20 years. So then there should be some sort of information you to decide what the useful lifetime. So other class of asset, I have to highlight one thing, that is motor vehicle. So it says what are the motor vehicle that is entered and not entered for capital allowances, right? Especially road vehicle. So that is not used for the, even we are using for the business of for the business during, I mean in the course of business, but we are not entitled to get capital allowances. Basically, these vehicles are as an example, I can say that motor car or the Jeep, that type of assets not entitled for capital allowances unless business is doing the renting business or the vehicle hiring business. That is a type of business they can claim. So balancing allowance or the accessible charges, balancing allowance says tax written down value is more than the sales proceed. In that case, balancing allowance or there is a tax loss. So if otherwise the other way sales proceed exceed the tax written down value, so then it is accessible charges. So that need to be worked out and separately. So therefore, remember first instance we are removing disposal profit or loss. That is as per the financial statement, accounting disposal profit or loss. Thereafter, we have to make this adjustment, right? Is that clear? Hello? Hello?
Yes, sir.
Yes, sir.
Right. Any question up now? Right. It says no question, right? Okay. So then, in case of the right of use assets, right, ROU assets, remember that is basically comprised with the what is this uh, assets under the operating list. Right now, we can segregate to two as per the accounting standard. One thing is right of use asset, other thing is operating assets. Right. For the tax point of view, we are deal with same. In case of the asset which have already been purchased under the finance lease or the acquired under the finance lease, that is treated as acquisition of the own. And if it is used in the business, we can claim capital allowances. But in case of the operating lease, as on the operating lease, we cannot claim capital allowances. Excuse me. Good evening. Hello. Yeah. So I will. Yeah, I will give you a call. I'm in a meeting. Okay. So then remember that under the ROU assets, there may be what is this amortization. So that is provision, it is not allowable. And also lease interest, ROU asset lease interest, that is also disallowable part, disallowable cost. And but rental payment, that is allowable, right? Therefore, rental payment, you have to separately identify that. We have to separately pick because it is not there in the comprehensive income statement. So you can deduct that one. Remember that assets should be used in the business, right? For the production of income. So gratuity payment, we can deduct that these things why I have highlighted it is not there in the comprehensive income statement or under any category of the expenditure, administration, marketing, or finance expenditure, but separately we have to figure out that thing and we have to deduct. So, so thereafter you have to check that assessable income from investment. So assessable income from investment, you have to check the category of income. So it could be dividend, rent, interest, that type of thing, royalty or whatever thing. That could be income. So important point here, you remember that when we work out the assessable income from business, we are removing. So separately, we have to work out the assessable income from investment. So therefore, under this category, we have to recognize exempt amount and final withholding amount. Reason is the investment income is subject to withholding tax or the advance income tax, right? So especially say dividend, if they have deducted, because it is mandatory now to the distributing company to deduct advance income tax at the rate of 15% right now, right? If they have already deducted that tax, so it shall be treated as final withholding claim for the recipient company. Or dividend paid out of dividend. So that means the company who received dividend, that dividend has been redistributed. So the second distribution is exempted income to the recipient, right? Could be rent, FD for the saving interest, which is on accounts maintained in LKR, is subject to AIT at 5%, and gross amount need to be considered for the assessable income. So that 5% withholding tax we can claim as tax credit. In case of the rent, the withholding tax or the advance income tax rate is 10%. You have to first check if there any rent income, whether it is gross or net. Remember, when we work out assessable income, it shall be always gross. So if it is not final withholding, we are considering that for the part of assessable income. So reason is in this context, we are work out the assessable income. So not the final withholding source, right? If any final withholding source, you can just mention that this is final withholding. So therefore, it shall not be part of assessable income. Treasury bill and treasury bond interest income, which is no withholding tax or the AIT is deducted right now. So therefore, that amount what we received shall be treated as gross income. So any foreign currency deposit account, that interest income is exempted, right? Remember. So, and dividend, that is, say, in case of the foreign source of income, that is also exempted. Say we have invested in an offshore company, we are getting dividend, that is exemption. Even we are disposing that part and taking that gains to the company, that is also exempted. Say company has invested in an overseas company, and thereafter they have disposed their the shareholding. So the gains received from that part is exempted, right? So other part is I want to highlight here. Under the investment income, we have to separately discuss that capital gain tax, right? Recognition of capital gain tax. So capital gain is arises on the investment disposal of the investment asset. So that's they have given the definition under the Inland Revenue Act. It says what are the investment assets? It says capital assets. Keep as part of investment. So remember, keep as part of investment. Capital asset keep or held as part of investment, right? That shall be treated as investment asset, right? So under that, there are four categories. First one is land or building. We keep as an investment. Yeah. Realization gain shall be treated as capital gain. Say building we are keeping as an business business or the depreciable asset, it is not capital asset. So if you are using in the business, it is not treated as investment. So we can claim depreciation the capital allowances on that. But in case of the investment asset, we are not entitled to get capital allowances. So therefore, if any disposal profit, we are liable for capital gain tax. That is, in case of the company, no, there is no difference variable rate or the different rate is 30% again. So we have to work out separate the gain. So what type of assets, that is land or building, membership interest in a company, partnership with the trust, the basically the shareholding of a company, and financial assets and any right or option related to the above three category of assets. So in such case, we have to separately work out the gain, and that need to be taxed at 30%. Remember, no any losses can be set off against the capital gain, right? So that is taxable income. So thereafter the taxable income, and the taxable income we can, before we work out the taxable income, we have to first work out the taxable income, the total taxable income. From that we can deduct qualifying payment and relief. In case of the company, it is rare we to claim relief. So therefore only qualifying payment we can deduct. So first thing is says donation to approved charity. It should be cash donation, and approved charity definition is there. The which is involved with the SICONED, institutional care for SICONED. So that, but there is a maximum limitation is 500,000. We can deduct, right, up to 500,000, 1/5 of the taxable income of 500,000. Basically, the maximum cap is 500,000, right? Thereafter, donation to government, special funds, or the institution what we have discussed, cash or goods, both are entitled. We can claim the deduction we can do for that type of qualifying payment. There is no maximum cap, right? And once we deduct this thing is called taxable income. So thereafter we have to apply the tax rate in case the company now it is 30%. And any tax credit we can deduct. Remember, especially if there any the investment in return and any withholding tax deducted, that can be deducted as tax credit. So that is basically the corporate tax computation. Basically, please focus on these areas what we have discussed. So under section 10, this allowable amount, right? And finance cost, improvement cost, and disposal adjustment of the capital as depreciable asset used in the business, and ROU and gratuity payment. So under the investment income, we have discussed so many areas, but please focus on dividend, interest, rent, exempt amount, and withholding tax liability, and the final withholding amount. Then the qualifying payment, cash donation to the approved charity. You have to check whether it is cash donation. If it is not, even though charity is approved charity, we are not entitled. But even cash deposit to the shall be approved charity institution what they established for the institutional care for economy and approved by the ministry. So if it is the case, we can deduct, but there is a maximum caps of 500,000 LKR, right? Any question? Hello.
That's one question.
Yeah.
Don't know it's difficult to ask, but sir, in the model paper we have few these adjustments in the question, corporate income tax question.
Yeah.
For the exams, do we need to prepare the adjustments other than those adjustments, or can we expect whatever the adjustments comes in the exam will be out of those adjustments what in the model paper?
I would say because I mean I covered the entire area, right?
In the model paper.
In the model paper,
Yes.
all, and also I'm the in the lecture series I have covered all the areas, right?
Yes.
So there may be some differences.
Okay. Okay. As a when it comes to interest expenses,
Yeah.
if the WST deducted,
Interest expenditure
if the
means?
net amount in the finance cost,
Yeah, finance cost means we have already paid, no?
let's say we have paid some interest for the working capital loan
From
or the interest for anything.
Okay.
For the short, let's say short-term loan, so
Okay.
that cost we can deduct, right?
Yeah, but only through these conditions need to be satisfied. The borrowed money has been used to purchase an asset or the construct on asset, and asset shall be used for the production of income during the year. or any borrowed money which is used in the production of income. In such case, that interest is deductible. We are not bothering about the short term, the long term, whatever thing.
Okay.
First thing, these two conditions need to be satisfied. Thereafter, that maximum limitation is applicable in case of the company.
Okay.
Excuse me, sir.
Yeah.
Sir, in case of this dividend income, so that you have said that this is the final withholding when we are receiving the income in perspective of the company.
Yeah, not only the company, the
So-
recipient hands dividends, which is subject to AIT at 15% is final withholding.
Okay, sir. So in the question, if it is mentioned that dividend income received, that we have to consider that this withholding, final withholding is deducted, or we have to assume and do, or what we have to do, sir?
A reason is, as per the law, it is mandatory to deduct, right? So the declaring company has to deduct dividend. There is no, I mean, the option their side. Declarant doesn't have any option. It is mandatory. So even in case of the say any in the declarant company fail to deduct that withholding tax, even that income is final withholding.
So that means we can assume in the examination question that the
Yeah,
dividend
if they have
income,
not given any additional income, you can simply assume, yeah, because dividend income is subject to withholding tax at 15%, which is final.
Okay, sir. And if any withhold any other income like interest expense, any withholding amount is deducted, so we have to in the total column we have to mention that gross amount, and that withholding section we have to mention that imagine now 5,000 is deducted, so
That's
then
right.
accessible part will be the balance part.
Yeah, it should be say. I mean, definitely in the question it should be mentioned whether it is net or gross in case of the any income which is not final withholding, right? If says net, that means say simply say interest that is equal to 95%.
Okay, so that mean
You have to
the
gross
amount
up that. Yeah, you have to gross up that thing and should consider for the assessable income that 5% you can deduct as tax credit, tax payment.
all right, okay, like the tax fraction.
Yeah, just like that. It's really not
Okay.
fraction, we call not, because we have to use that. We have to consider the gross income. We are dividing 95 and multiply by 100, that is the gross amount. And 5% we can deduct as tax credit. In case of the rent, it is 90% in case of the net. So 10% we can deduct, but in case of treasury bill and treasury bond, there is no AIT. The previously in Sri Lanka, we have that primary market transactions. Right now, it's not there. Therefore, no withholding tax. But in case that amount what we received on the accrued for the period, we have to consider the total amount and no tax credit.
Okay, that means only treasury bills and bonds will be should not be taken in that scenario, right?
Yeah, it's, I mean, there is no tax withholding tax involved, or the advance income tax on treasury bill and treasury bond.
Okay, sir. Thank you.
Any other question? Hello. So then, so I will conclude that what the assessable income or the corporate tax computation. So thereafter the non-resident tax liability. So basically, focus on the business income, right? And
Excuse me, sir. Sorry to interrupt.
Yeah.
What are the other areas can be incorporated in that income tax question in theoretical aspects?
What
If
do
you
you mean
can
then?
give. I mean, like any other tax liability that what kind of a thing can be any
No,
focus area is that?
only the focus area is the computation of income tax liability that comprise the computation of assessable income, taxable income, and tax payable. Any exempt amount or the final return amount you have to mention.
Okay, thank you.
So shall I move to this area?
Yes, sir. Thank you.
Right. So then in case of the non-resident, so the focus on the business income, because I have given the assignment related to that one group assignment. My expectation is from your side to get that areas to cover as a group discussion. And so in case of the non-resident enterprise, you have to check whether there is a PE creation in Sri Lanka, PE established in Sri Lanka. If there is PE, so therefore, in such case, the business income is liable for Sri Lanka tax asset. So under the PE creation, there may be prima facie PE, service or the construction-based PE, agency-based PE, right? Basically, this type of thing. So under prima facie PE, that means that is it says permanent establishment means there is a business location which is in nature permanent, and the enterprise is doing business from that particular place. In such case, we have to consider there is a permanent establishment or fixed business place in Sri Lanka, right? You know that in case of the non-resident person, the person is having a source in Sri Lanka, they are liable for Sri Lanka tax, right? So under the permanent establishment, so it's discussed under the Inland Revenue Act as well as under if there are any double tax evidence agreements between two countries, so then that double tax evidence agreement is applicable. So in the double tax evidence agreement, it's defined what is PE, permanent establishment. So Article 5, in the examination context, you will be provided that the relevant article. So you have to check whether, as per the article, whether it is a permanent establishment or not. If it is a permanent establishment, that particular income is, we have to work out separately as a separate or the distinct entity, and that entity is liable for tax as a corporate. Right? Say foreign or the offshore company or the foreign company, they are setting up a branch office in Sri Lanka. Then branch office shall be treated as separate entity, and we have to work out the tax liability on the entity, right? So we have to apply the domestic law when we work out the assessable income, the taxable income. So therefore, IR Act is, Inland Revenue Act is, it's applicable for this non-resident asset, right? Say a branch office having a depreciation expenditure, it is not deductible. But if it is a depreciable asset used in the business, we can claim capital losses. Entertainment expenditure, we are not allowed to deduct, right? Bad debt provision is not deductible. And also you have to consider provision of the double tax evidence agreement. If it is there, definitely in the examination context, the question related to this non-resident computation. So double tax evidence agreement will be there, right? Under double tax evidence agreement, Article 7 says special treatment that need to be considered when we work out the profit of the permanent establishment, right? So what type of expenditure? It says some are restricted to deduct. Simple example, say there is a branch office and the money has been obtained or the loan has been given by the head office, but the interest is not deductible expenditure, right? You know that under the Revenue Act, it says if it is incurred in the production of income, used for the production of income, we can do it. But as per the double tax evidence agreement, so agreement says what these type of things are not deductible. You have to check that one. Say simple example, say in the China Sri Lanka agreement, it says, but some agreement not. So therefore, you have to carefully read that particular article and apply. So the question will be easy because so relevant article will be provided, right? So once you work out the profit, so it's a matter of apply the current tax rate, which is 30%, because it shall be treated as separate entity, and work out the tax liability. If then remaining profit, remember, it could be liable for remittance tax at 14%, remember, right? In case of the non-resident person, profit remittance is subject to remittance tax at 14%. So I explained in the lecture that in case of the resident company, residual profit shall be distributed as dividend. Dividend tax rate is 15%. In case of the non-resident person, residual taxes shall be remitted. So profit remittance shall be again, that is profit after tax. Profit after tax. If we are remitting to that particular non-resident person, it is again liable for tax at 14%, that called remittance tax. Right? If there are any tax payment details, we can deduct. Is that clear? Hello.
Yes, sir. I have a small question, sir.
Yeah.
If the profits are not remitted, then like if they retain the profits,
Yeah, there's a separate section we discussed in the classroom as well. If they are keeping in Sri Lanka for a period of 3 years and investing as or the using the expansion of the business or investing in treasury bill or securities, and after 3 years, if they are remitting, there won't be any remittance tax. Well, reason is that remittance tax is applicable at the time of profit remitting. Is that clear?
yes, sir.
Right.
So one thing, what about the head office expense allocation part? Can you just recap that part?
Yeah, in case of the head office expenditure, right? Head office expenditure, even though they are deductible, there is a maximum limitation. 10% of the assessable income you can deduct. Up to 10% of the assessable income from this you can deduct.
Okay, so thank you.
So then we focus on the business income to a non-resident person and PE creation under basically under these three category. So under Article 5, it says the recognition of PE and keep the you are focused on the recognition of business income and application of the IRD law and the income tax law, inland revenue law act and the tax treaty respective article, which is basically Article 7. And thereafter you can work out the profit and apply the rate and work out the tax liability. Right? Hello. Shall I move to the next session?
Yes, sir.
Next area. Right. So then value-added tax and the
Sir,
value-added yeah.
sir, regarding the first question, the income tax, so we will get any theoretical questions other than the calculations?
Theoretical question means I mean the tax is always theory, right? I could say it's say they can ask. I mean it could be there. So application, practical application of so taking a business when we are taking a business decision, how we yeah. Clear? Hello?
Hello, sir. Your voice is like the connection was cut in between.
Hello, can you hear me now? Can you tell me whether you can hear
Yes,
me or
sir.
not?
So can you
Right. Yeah. So what I told you, so there may be some sort of question which is related to the taking decision, right? I'm not expecting you to work out the whether to go with that thing or not, but the applicability of taxes. Say, so I'm right now I am doing an import and local sales. So I plan to do export. So from that export company, whether to set up a company or not. So right now I am manufacturing my goods and selling to the market, and I'm planning to set up a separate company to distribute that thing, or I'm going to appoint some agent, that type of thing. That type of question could be asked. So you to just to mention what type of taxes applicable, right? So that could be there under the corporate tax the question related to the resident company tax liability. With that, so say company is going to distribute dividends, so what the tax rate application, right? So they are going to distribute cash division, or they are going to issue paper or the bonus shares. What are the tax implication? Right, that type of question will be there. So because we learn income tax, value-added tax, SSCL, you can mention. You have to mention that. Okay. Somebody asked whether
Okay, sir.
any. Okay. All right. So if I move to that value-added tax question, so definitely it should be you know that as per the value-added tax there are two arms, two legs, that is output tax and input tax. Output tax is on our supply, so it could be liable for tax at standard rate 15% or the 18%. The examination context, you know that after 1st January 2024 tax rate is 18%. Before that thing it is 15%, right? So standard rate is, yeah.
Sir, can you share your screen, sir?
Not sure. You can see my screen, right?
Yeah, no, it's okay, sir.
You can see my screen, right?
Yes,
Yes,
sir.
sir.
The presentation. Right. The standard rate and for the examination context, I will mention what the rate because there's a difference between the rate effective from 1/1/2024. Basically, I will my plan is to discuss the tax liability in case of the VAT liability which is related to the period ended 31st December 2023. So therefore, the standard rate could be 15%. And any exports, offshore services, that type of income which could be zero rate. And asset supply. So in case of the RIS, we are making any supply to RIP. So that is also subject to tax, just like standard rate supply. But that we are not collecting the VAT amount in cash. Therefore, we are disclosing the VAT liability and we are entitled to get tax credit under the tax payment, which is asset credit closure, right? Equal to the VAT amount on the asset supply, right? Keep mind on that. So then input tax, it could be imports. In this case, even capital nature assets or any raw material utilized for the business, we are entitled to get the input tax. So imports basically is goods. Local purchase, it could be goods or services. And thereafter, we have to check if there any disallowable input tax as per the VAT law. VAT law says some type of input tax is not deductible. Its first thing it says any input tax related to the taxable supply can be deductible. That means if any input tax is related to the exempt supply, it is not deductible, right? And if we don't have valid tax invoice, so we have not claimed within the permitted period or the lack of the valid period to claim that thing, that is disallowed. And also important point is motor vehicle used for traveling purpose. Any expenditure on such expenditure, if there any input tax, it is not deductible. So disallowable input tax. And thereafter the how to set off input tax. So we did some question and it's related to the zero rated and asset supply. So if there are any direct amounts, we can deduct as against output tax. And if there are any common input tax, we have to use some basis that basically is based on the value of the taxable supply. So common input tax, we have to divide by the total value of the taxable supply, multiply by the value of the asset supply and zero rated supply value. So that amount we can set off against the output tax. And in balancing is related to the standard rate supply. If then brought forward amount, allowable input tax brought forward from previous taxable period, we have to add then there is a maximum limitation of deductibility of the input tax, that is 10%, 100% of the output tax, right? That's the amount we can deduct. So thereafter the tax liability for the period. So what we can deduct tax credit. As I mentioned, that is then asset supply. So you remember that there should be asset credit voucher amount, which is equal to the output tax that can be deducted as tax credit, and installment tax payment which related to the relevant taxable period. So we can deduct, right? So a simple question will be there. Okay. Any question related to the VAT? Hello.
Sir, I have a question.
Yeah.
Sir, this is regarding land sale business that they are buying and selling lands. So,
Okay.
are they liable for VAT?
Yeah, it says how to how that need to be in case of the real estate, how we can deduct, how we are liable, right? It says in case of the land and improvement. So improvement part will be liable, not the land.
That means a development.
Part. If there any
Expenses?
development, yes, that need to be separately worked out. Say, after purchasing land, they have done any structural changes to that particular asset land.
Yeah.
So that part will be there. It shall be liable. On the, but
Okay.
on the land, only they are doing with the land, so there won't be. We can have the law says land and improvement. Improvement part should be liable for that. Land part is not liable for it. How it should be worked out, you have to get the total disposal proceed on the land and improvement. You can remove the market value of the land at the time of the supply, or the date of sale. Market value equal to the one what we realize on that. Therefore, on the land part, there won't be any backline. But improvement, yes, but improvement also there's a before 1998. So if that cost we can deduct when we work out the value addition. Okay.
Okay, sir. Thank you, sir.
Anything to discuss? No? Right. So then social security contribution levy we discuss. So basically it is on turnover. So in case of the manufacturer, 85% of the turnover we have to consider, and on that 2.5%. In case of the service provider, total revenue we have to or the turnover we have to consider on that 2.5%. In case of the wholesales and retailers, there are two categories: import and local sales, or the local buying and selling. 50% we have to consider on that 2.5%. In case of the registered distributor, that means there is a definition for who is the registered distributor, that local manufacturer who appoint a person to distribute that his goods in the domestic market or the wholesale market at a given price by or the price determined by the manufacturer, he shall be treated as registered distributor. In such case, 25% is turnover, 2.5%. Remember that the SSCL is on the turnover says received or receivable. In there, if receivable means if there are any value-added tax amount, we can remove that one, or the bad debt we can remove. So balance thing we can consider, and on that 2.5%, there is no input tax deductible to the SSCL paid on the purchases. Such there is no input tax credit mechanism, no credit mechanism for input, and balance tax we have to discharge by installment. So remember, the installment paid for the relevant period need to be considered, right? That is related to the SSCL. So as I mentioned that previously in the planning question, so some business decision making question. So ask what type of taxes, so what are the things that need to be considered. So they are coming with a proposal, you to give some advice. So you have to mention this is manufacturer, so then it could be liable for SSCL, right? Remember that registration threshold and all those things, and based on that you can construct your answer. As well as there will be small question from SSCL. Okay. Hello. Hello. So then I will move to that other areas, the tax payment and credit. You know that installment tax payment. That there are three ways to discharge tax liability in Sri Lanka. One thing is tax payment, or the other one is without other way of withholding tax by tolling. Other one is by assessment. So installment payment, if any installment payer who has to work out estimated tax rate for the year, and it need to be discharged by 4 installment, right? So at the first installment due date, it is required to submit the statement of estimated tax payable for the year. Based on that estimate, you have to discharge your tax liability on installment basis. When we make the installment tax payment, so by due date, if there is tax rate, we can deduct. Right? We can deduct that tax rate and balancing we need to pay. Say, once I work out my tax liability is 100,000 liability, 100,000 for the period, right? So I am having a rent income. I have considered that rent income when we work out my estimate liability. So rent income is subject to withholding tax. So if that the payer has deducted withholding, I can deduct that withholding, right? Withholding pay and installment payment up to the day where that installment is worked out, we can deduct. So the computation, that means the set computation we can work out as per the estimate, best estimate. That's asking the return has been given to the taxpayer. He can estimate his income, deduction or whatever thing, and based on that he can come with an estimate what we have given to the tax authority or the Commissioner General can be revised before the next installment payment, right? So revision, otherwise that the statement is prevail for the whole year. So withholding tax, we had a detailed discussion. Please remember that one. So there are 3 areas, that is remuneration, salaries, and that type of thing is subject to APIT. Of course, you can say that in case of the say more than 100,000 remuneration benefit, total employment benefit is more than 100,000 is subject to APIT, right? Monthly remuneration more than 100,000, and investment return just like rent, dividend, interest, that type of thing subject to withholding tax. We discuss tax rates and service fee, especially in case of the business person who is making a service fee to resident individual. So if it is more than 100,000, some payment, right? So categories, some category just like engineer, consultant, doctors, accountant, software developer, that type of thing. So the lawyer, service fee is more than 100,000 for the payment or the per month for a month. So it's required to deduct 5% withholding tax. And investment return, just like rent, is subject to the 10% withholding tax if it is more than 100,000. So on the total amount, we have to deduct, right? Dividend, irrespective of the amount, 15%. Other than if the dividend is issued out of dividend income. And royalty, 14%, right? So we discuss what are the final withholding amounts. Please focus on that as well, right? So basically, these are the things that I want to discuss with you. If you have any questions, you can. This is something that you should have. I trust you prepared for this session and you are coming with questions. Please ask. So
So can you discuss that question number 3 in the module paper?
module paper question number 3. What?
It's related to that PE establishment. RJ Interior Private Limited.
Module questions. Can you see my screen?
No, sir.
Right. So can you, now you can see my screen, right?
Yes, sir, we can see.
So it says RJ Interior Private Limited incorporate and resident company in Malaysia. So the company is resident company in Malaysia. Therefore, in case of the Sri Lankan tax point of view, it shall be a non-resident company for Sri Lanka tax, right? Company manufactures furniture used for the hotel industry and engage of providing interiors designing services. Company has been offered an interior designing and finishing project by a hotel Deodara Private Limited, a company incorporated in Sri Lanka. So the Sri Lanka person has given a has offered a service contract to the non-resident person. So in such case, Sri Lanka resident person is making a service fee payment. Then there is a source in Sri Lanka to that non-resident person, right? So first thing is that first thing you have to check in case of the non-resident person whether there is a source in Sri Lanka. So it's very clear there is a source in Sri Lanka. Project has been offered. So project period was 1 year. Total project cost estimate by RJ Interiors is 700,000 or 700 million. And quoted price for the project was 1 billion, right? So that means their income could be 1 million, 1 billion, and 700,000 could be the expenditure. So RJ Interior Private Limited has manufactured furniture for the project in Malaysia and imported to Sri Lanka. The cost of the importation of furniture was 350 million. So, right? Cost of the salaries paid to design work was 200 million. RJ Interior Private Limited has sent their employees to Sri Lanka for facilitating the design of the furniture and interior works. So they have sent their employees to Sri Lanka. Now, first what they are doing, they are manufacturing the furniture in Malaysia, and they send that manufacture the finished good to Sri Lanka. That they have mentioned what the cost, furniture and the design work, right? Altogether 550 million they have mentioned that. So that thereafter they have sent their employees to Sri Lanka to that interior works. Remember that they have sent their employees to Sri Lanka. Now we have to check. Now non-resident person, first thing is they are doing business with Sri Lanka. There's an income, but if there any double tax evidence agreement, of course, with Sri Lanka and Malaysia, we have a double tax evidence agreement. So under that, it says the business income is taxed in the resident country, unless there is a PE creation. So then we have to check whether there's a PE. Because they have sent their employees to Sri Lanka. They stayed at the hotel project office. It says hotel project office, right? So under the Sri Lanka and Malaysia treaty, you have to check. So whether it is a prima facie fee or not. So project office, this is construction based fee. So if the project office means it shall be treated as a permanent establishment, right? So they are staying there because they are not bothering about the how many year period, what the period they are staying in Sri Lanka if it is a prima facie fee, right? Okay.
Okay, sir, I got it.
Is that clear? So
Yeah.
thereafter, when you have to work out business profit, right? Business profit from the this engagement. So if the business profit is there, so then it shall be liable for tax. So then you have to work out the tax liability, right? So remember, say if it is a prima facie fee or the fixed, there's a fixed business place in Sri Lanka, we are not bothering about the how many, what the period they are spending in Sri Lanka. Right? It could be 1 month, it could be 2 months or 3 months, whatever thing. So if it is there, so we have to work out the business profit. Okay.
Okay, sir. Okay, sir.
So then non-resident person, in this case, non-resident person is liable for Sri Lanka tax. But is there any expenditure incurred by that particular, let's say employees come to Sri Lanka, then that salary cost may be there and all those things. So that is deductible expenditure. Only thing is you have to check whether it is incurred in the production of income. So thereafter says RJ Interior has obtained expert consultant services from Miss Celestina Lee, who is a Singapore resident person. So another person is coming that is also consultant. So it says that that employee base fee could be a trigger even they are using consultant. And remember in this case, first you can see that first thing is the tax liability of the company, non-resident company. Second thing is they are sending their employees to Sri Lanka. They spend in Sri Lanka 2 months to pursue design and manufacturing plants. So they are exercising employment in Sri Lanka. Non-resident employees, individuals, they are exercising employment in Sri Lanka. Then they have a source in Sri Lanka, but still they are non-resident. They are also liable for Sri Lanka tax. They are remuneration. Well, for the company side, it is the expenditure, but in the recipient side, the non-resident individuals, they are liable for tax in Sri Lanka as per this. So you have to read that dependent persons related article and check whether that employment income is taxed in Sri Lanka or not. And thereafter it says that the experts or the consultant, independent consultant coming to Sri Lanka is a Singapore resident person. Now another agreement is involved. Right? Consultant agreement was entered with RJ Interior Private Limited with Celestina with Sri Lanka for a purpose. She stayed at the project office during the project implementation period. Cost incurred by the company for about was 100 million. So then you can simply work out that 1 billion minus the expenditure incurred, balance things shall be treated as income and liable for tax. As per the question, it says discuss with the RG Interior Private Limited employee and interior consultant are liable for income tax in Sri Lanka in respect of any profit arising from the hotel project. Supply of consultant service are made by Celestina to the above project in Sri Lanka. So that is as per the relevant double tax agreement. You have to read and apply. So it's not asking whether what the tax liability, whether liable or not. So then first thing is you have to decide. So three party involved here. RG Interior Private Limited is a Malaysian resident company. Therefore, it definitely is a non-resident person for Sri Lanka tax. Employees, they stay in Sri Lanka 2 months. You know that under section 69, 1B says the number of days, right? Quantitative measures, number of days whether they are spending in Sri Lanka. Within a 12-month period, if more than 103 days, they are resident, right? But in this case, it says 2 months they are spent in Sri Lanka. Thereafter, we have to check what is the application of double tax agreement. So how it's interpreted? And it says in which country they are liable for tax. Right? Employment income, if they are exercising in Sri Lanka, it says the three conditions. So if it is not the case, they are liable for tax only in their resident country. Right? Thereafter, the consultant, which is coming to Sri Lanka, and that she is also getting income from Sri Lanka. That means the source is Sri Lanka. So thereafter, you have to check whether it is paid by a permanent establishment or not. So if that condition is satisfied, so then she will not be liable for Sri Lanka tax, otherwise liable. Okay, that is the way you have to approach. The first thing is to determine whether that particular party is resident or non-resident. Thereafter, whether they have a source in Sri Lanka. Then what is the application of treaty? If they treaty double tax avoidance agreement, what article need to be applied? Under that, how you have to work out. Is that clear?
So one more doubt, sir, regarding this Miss Celestina.
Yeah.
Its question is mentioning that she stayed at the project office during the project implementation period. So basically, she stayed 1 year in Sri Lanka.
Yeah.
Because in that, then she become a resident person in Sri Lanka, no? Because she
Yeah.
stayed in Sri Lanka more than 183 days.
Yeah, correct.
So then she is liable for AIT tax, correct?
It is because it's you have to check whether that particular person is what type of things they are doing. It's a consultant, right? Just
Yeah.
consultant. Once it's resident individual, consultancy is not under the independent professional category, right? Only that the engineer and architect and all those things.
Okay. Okay, so
Even they are liable for AIT once it become, because in case of the AIT or the advanced income tax, non-resident persons, it is final, right? But
yes,
if they are resident, it is not final. If I simply say that, say, yeah, so she is she's a resident person for Sri Lanka tax person with 12 months, she is staying here, right? So then the total income she has to consider. This is his trade business profession. this or the trade professional vacation income is a professional income. So then it's any expenditure she can deduct, and thereafter she can claim, because resident person can claim 1.2 million that tax-free allowance, and then she has to work out tax and pay. If there are any withholding tax, she can claim, otherwise not. She has to pay as per installment payment. So that is the difference between, say, in case of the individual, she is non-resident, withholding tax is final, pay and finish, right? But if she become a resident, it's not final.
Okay, sir. Okay, I got it. Okay, thank you, sir.
So one more doubt about this question. In this Celestina, since this RJ Interior is the company from Malaysia sending this Singapore to Miss Celestina to Sri Lanka, doesn't it create a consultancy piece?
I mean, basically, a P is created for the enterprise. This case, it's created a fixed base. Independent personal income is a fixed base.
Okay, that means that enterprise is sending.
In case of
yeah.
No. In case of the enterprise, we call it as fixed permanent establishment. In case of the individual, we call it as a fixed base. If there are any fixed business place in Sri Lanka to individual, yes, it is also based. That fixed business place is defined how it's happening. Is there any definitely office, that type of thing? Yes, fixed business place. Otherwise, if she is staying in Sri Lanka more than 183 days, yes. And in some cases, it says 90 days. Right? Then you have to refer to the article and see. Of course, even that if she is more than 183 days, automatically he should become a resident person for Sri Lanka. We are not then bothering about that one, because then she is resident person for Sri Lanka. In case of the non-resident person, the double tax evidence agreement is applicable.
Okay, that means even though this Malaysian company is sending this consultant, we shouldn't bother about that one, and we should look in the perspective of independent services, right, sir?
Yeah.
Okay.
So you refer that there are the categories we discuss: income, service income, right? It's under that it says in case of the fees that making the payment, in case of the non-resident person, if you are making that payment, that type of thing we are taking out, right? Okay.
Okay, sir. Thank you.
So then basically we need to see then from where the source of income is arising, rather than that
First
under
thing
whom
is, whether is that particular person is a resident or non-resident, right? Residents. So there is no, the importance of this application of the double tax evidence act, because resident means she is, although he is liable for Sri Lanka tax as per the domestic law, right? So in case of the non-resident, then we have to check whether there is a source in Sri Lanka. Okay.
Okay, sir.
If there's a source in Sri Lanka, then you have to check in, especially because you read this thing again. Especially, I'm telling to for your knowledge purpose. Especially, say that payment is made by a non-resident person, and the P, that's a separate application on that. Right? Then we have to check whether that she is liable or not.
Okay, sir. Okay.
And the employment also, I mentioned that there in the most agreement it says there are 3 conditions. All 3 conditions need to be satisfied. If it is the case that employment income is taxed only in the resident country, otherwise not. Simply I put it in this way: if there is no double tax evidence agreement, in non-resident person is receiving any income from Sri Lanka, then they are liable for tax in Sri Lanka as well. Right? So difference between the country where the double tax evidence agreement is there, then some occasion that we don't have in the Sri Lanka don't have a taxing right on the non-resident's income. That's the difference. Say that we are getting consultancy service from China. We are making payment to China person. He is not coming to Sri Lanka. From China, he is in China and he is providing services to Sri Lanka. So when we making the payment, as per the China agreement, says that income is taxed only in that country, resident country. Therefore, we don't have right. Say we are making a payment to Hong Kong, right? Hong Kong, person who is in Hong Kong and he is doing that same services from Hong Kong, not China, from Hong Kong. Right? We don't have a comprehensive agreement with Hong Kong and Sri Lanka. It's a limited agreement, and that service income is not covered. Therefore, if we are making any payment, we have to deduct 14% withholding tax as service fee payment. Is that clear?
It's clear, sir.
Right. So that need to be checked. So, but there are another exception, right? Because if in case of the permanent establishment, if you making the payment, whether that particular unresident person is liable or not in Sri Lanka, right?
Yes, sir.
Right. Any area to discuss? Hello?
So in case of the paper structure, what is the structure, sir? The elective questions will be from any part. You can give an idea for us.
Basically that corporate tax computation, it is mandatory, the compulsory question. Non-resident is compulsory question, but is compulsory question, right? So other part, there is two part in the paper. First part, that is mandatory question. Second part, there will be elective questions. Say out of 3 questions, 2 questions you have to answer.
From the elective second part, right, sir?
Yeah. Because as per the your syllabus content, it says so areas to check that. Therefore, I have to give that. Follow that instruction and set up that paper. So that's not talking now. I expecting so many questions from your side. Hello? Hello?
Excuse me, sir.
Yeah.
Regarding to the non-resident question, do we need to do any calculation regarding for that question?
Yeah.
Not only the in that model paper you provided, there are like a case study, no? So in our end semester examination paper, do we need to?
There will be a small computation. Next slide. Just as per discussion also, they have given that, I have given that what the total income and the expenditure, no? So deduct, whether you have to check whether that particular expenditure is deductible or not. If it is deductible, yes, you deduct and thereafter apply the rate. That's only. It will be
Yes, so
small calculation. Yeah.
So we need to get the idea from that the regarding treaty, right?
It goes in this way, right? And the first thing is any expenditure you have to check whether as per the domestic law is allowable. As I mentioned you, it says that we have a branch in Sri Lanka, so non-resident person have a branch in Sri Lanka. So in the branch having a depreciation expenditure, it is not deductible. But for the particular asset, they can claim capital losses, right? And also in the double tax evidence agreement, it says, so any restriction of the expenditure, deductible expenditure. So then you have to follow that.
Okay, sir. Thank you.
So I will show you that Sri Lanka, China DT again, right? So as per this one, you can read. This say Article 5. It says permanent establishment, right? See, it says permanent establishment means a fixed place of business, through which the business of an enterprise is solely or partly carried out. It says enterprise, right? Thereafter it says these things includes specifically. So then we cannot avoid. So a place of management, a branch, it says branch, an office, and factory, a workshop, a minor, this type of thing, right? Thereafter it says the construction based building site. So we are not bothering about this. Thereafter it says project activities continue for a period of more than 183 days that they are giving. So in the case of the service base, including consultant services, so it is also more than 183 days. So then it shall be treated as a non-resident company or the enterprise having a permanent establishment, right? And then Article 7 says business profit. Says the profit of an enterprise of a contract nature shall be taxable only in that state unless the enterprise carries on the business in other contract nature. So remember, this is related to the enterprise always, right? So thereafter it says these type of things. So it shall be treated as separate entity and separate enterprise and similar independent entities doing. So in that way, we have to work out the taxable income, right? And thereafter says in determining the profit of the permanent establishment, there shall be allowed as reduction expenses which is incurred for the purpose of the business of permanent establishment, including executive and general expenditure so incurred, whether in the state in which the permanent establishment is situated or elsewhere. However, thereafter says, however, no such deduction shall be allowed in respect of amount, if any, paid. So it says this type of thing by way of royalty, fees, or any other similar payment, return, patent, or other rights, by way of commission. So the service perform more management fee, service fee or management fee, that type of things. This article says it is not deductible even it is incurred in the production of income. Therefore, in such case, this is supersede the inherent law. So you have to apply this one and work out. Right? This first thing it says in the other countries liable. So in say China, non-resident companies, they are doing a business in Sri Lanka through a permanent establishment. So then it's an non-resident person having a business income in Sri Lanka. So then we have that separate entity, enterprise has a, we have to consider as a separate enterprise and we have to work out the taxable income. Right? So, but even that, as I explained here, please say the branch office is making a royalty payment to the head office, it is not a deductible expenditure. Branch office is paying interest to the head office, it is not a deductible expenditure as per this article. Okay? That clear? Hello? 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 Sandharwan, can you hear me?
Yes, sir, we can hear you.
All right. Is that clear what I explained?
Yes, sir, I got it.
Yeah. Okay. So any questions?
No, sir, nothing from my end.
Okay.
Excuse me, sir.
Yeah.
Sir, this is regarding the corporate income tax liability.
Okay.
Sir, when we have a capital gain from
Yeah.
selling an investment asset, so
Yeah.
how are we going to compute the tax liability when we have the other sources of income as well?
No, I mean so I will say that in I think your question is whether say I'm running the company is doing a business, right? So then business income we have to work out separately, right? Because taxable income we are working out and also assessable income from business, right? We have worked out assessable income from business, and such cases there may be assessable income from investment. Assessable income from investment means it could be, as I mentioned, the category of income just like interest and royalty and all those things, as well as if there is a realization of investment asset, that is also part of assessable income from investment, right? So then we have to work out the gain and we have to include the assessable income from investment and total assessable income, thereafter taxable income. Or when we work out the taxable income, we have to separately take that capital gain and tax at 30%. Is that clear?
That means now from the taxable income, first of all, we have to segregate the amount we have recognized from the selling of this investment asset.
That's right. So just like say, under the investment income, when we work out the assessable income from investment, we have to include that part, right? So thereafter, we have to work out the taxable income. From taxable income, you remember, so I mentioned in the computation, taxable income and tax rate. Under taxable income, you can mention this is capital gain, tax at 30%.
Okay, sir, got it. Thank you.
Any other question? No, Ardana. I like all names.
Excuse me, sir.
Yeah.
Can you explain the model question? Question 1, part B question.
Question 1, part B. Can you hear me? Vandar, can you hear me?
Yes, sir.
Can you hear me?
Yes, sir.
So, can you hear me, please?
Yes, sir.
Can you hear me, please? I can't hear you.
Yes,
Sir,
sir,
we
we
can
can hear
hear.
Right, okay. So I think I trust I have discussed this question right in the class anyway. So it says Let me to share that one. It says the adjoining land to the factory location. And there's technical issue. Okay, right now you can see my screen. Hello.
Yes, sir.
All right. So as for this one, they are going to they acquire that land, and the directors coming with marketing directors coming with two proposals. One thing is purchase the land and at 50 million and resell the land after 1 year at 75 million. So balancing the profit they can use to distribute dividends, right? So in such case that you have to, there are two options. They are coming with the two options, so you have to evaluate that. Right? I mean, they say just say what type of taxes are liable and how is liable. This says first thing is they are going to purchase the land, and thereafter it's keep as a investment, right? And they are going to sell it. So then that is 30, 25 million they are getting profit, that is taxed at 30%. Right? And second thing is the out of that profit they are going to distribute dividend. Dividend again taxed at 15%. It's all AIT, advance income. That is the tax implication there. So because of this is land, there won't be any VAT liability and there won't be any SSC liability. And second part is purchase the land and lease out to prospective buyers until rental pays for rent, because this is land is operating lease. So therefore rental income will be part of their income. When the company, the tenant making that payment, they will deduct withholding tax at 10% or the AIT as 10%. Rent income is liable for tax at 30%. They can claim that withholding tax credit. And also rent income, if the company is liable for VAT, well, the registered for VAT, the rental income will be liable for VAT, as well as rental income will be liable for SSCL based on the, what is that? Total turnover at registration threshold. So if it is exceed that thing, it is liable. So thereafter it says purchase consideration can be settled from a bank facility available with the company. So first one is, it is related to the capital gain. So investment asset, purchase of investment, any interest cost. So that part of that thing you can check, they can deduct, but because of the company there may be maximum limitation. And that is the expected answer. Have I answer you can show?
Excuse me, sir.
Yeah.
Can you explain the fourth question also, the way of writing for 10 marks for the last question? Fourth one.
Which question?
Fourth one.
This one? Fourth one.
No, question 4.
Right. It says it's an Indian company. Company manufacture interior solution product and engage in providing interior design services. Company seeking expansion their business to Sri Lanka market. They are evaluating following options: set up a branch of its interior, incorporated subsidiary company Sri Lanka. So then two options again. So first thing, under first one, they are asking applicable taxes. So they do what the business manufacturing interior and solution there. Yeah. So if they are setting up a branch office in Sri Lanka, then first thing is they are non-resident. Sashika Interior Private Limited, sir, incorporated company in India. That means it's a non-resident company for Sri Lanka tax. If they have set up a branch office in Sri Lanka, then there is a permanent establishment. So the permanent establishment is liable for tax in Sri Lanka as a normal. I mean the a distinct entity or separate entity. The profit will be liable for Sri Lanka tax. Right? That's the under the option 1, income tax liability. And also because they are doing activities supply in Sri Lanka, they will be liable for VAT, as well as the turnover is more than that limitation, they will be liable for SSE. So if they are setting up a separate subsidiary company in Sri Lanka, subsidiary company means it's a resident company for Sri Lanka tax. So resident company is liable for Sri Lanka tax. You know that. So and that if they are paying any dividend, that could be liable for withholding tax, AIT, and because that is not exempted services for VAT as well as SS, that could be liable. That's the area that need to be considered. Hello? Advansi asked, right? Is that clear?
Yes, sir.
So that's the time I'm not expecting the computation in that type of things, but in the examination context, there will be computation. Because I have given this type of question in the group assignment to evaluating the options, so therefore that type of question will not be there in the question.
So can you explain the question number 3, what the computation part, how to arrive the liability of the non-resident? Just what is the structure it could be and how we have to derive it?
No, the no separate because it says as a distinct entity, they are liable for, they have to account the tax liability. So same thing. So first thing is profit before tax, and is there any disallowable, allowable thing, you have to separate the deal. And when we are, keep it in mind, when you work out the disallowable amount, you have to refer to the double tax avoidance agreement for the special treatment, just like say commission payment, interest payment. If it is there, that is disallowed. So thereafter taxable income and apply the tax rate and count.
So in this case, can we consider this 100 million as the income and the 700 million
1
as
billion.
the
I mean, even that is estimated now. So the income you quoted price is defined, right? It's for the 1 year. So therefore you have to consider, you can make an assumption that is for the year of 12 months. So that the actual basis we have to recognize no income. So expenditure, they have given the breakup. Not the entire 700,000.
So we shouldn't take the 700, but the other things, right, sir?
So the real actual expenditure you can consider, because that is estimated expenditure, no? Okay. So estimated thing we cannot deduct. Actual expenditure incurred, that means expenditure incurred we can deduct, right?
Okay, right, sir.
Okay.
Yes, sir. Thank you.
Any more question? So is Mulu there? Batch representative Choria, right? 16 exemption.
Yes, sir.
And the other one is Mulu, right?
Yes.
Is Mulu there? What is his surname?
Yes, sir.
Yeah, there, right. Okay, so is there any question you can send me, right?
Okay, sir.
Okay, sir.
Right. So I mean so if I wrap up the discussion, so basically focus on the computation of corporate taxation right? I mean, the question what we have discussed under the model paper. And tomorrow or the day after tomorrow, I will give some other question, model question related to this one. And with the answer script, so you can follow that thing and see how you should answer that one. And in the VAT computation, keep in mind on the standard rate supply, zero rate supply, and insert supply, and the allowable input tax and allowable and disallowable part, and how you should set off the input tax against the output tax, right? And SSA liability we discuss, and withholding tax and income tax payment, installment payment, withholding tax payment, and the return submission dates, the administrative provision, and what the non-resident computation, the small, in case of the enterprises doing business in Sri Lanka, if they need or the fixed business place, how we should treat that type of thing, as well as I trust that you have that reporting writing skill. You if they ask you some sort of question that regarding just like this board of directors coming with options, so just set up a structure and answer that one. So in this case, say option 1. So income tax, liability of income tax, liability of elevated tax, liability of SSCL. Likewise, you can mention distributing of dividend, how it liable. In case of the rent, what is the applicable tax? That will be the expected answer. Right. Question number 1 is entirely the computation part. Basically, we covered these areas. That focus on that.
Excuse me, sir.
Yeah.
Now, are we getting questions from transfer pricing?
Transfer pricing, computation, and etc. No.
That means not even a theory part, sir.
Theory part. Yeah, you can just mention that the application, because say if they asking that type of question, you can answer that. Try to say they are setting up what the company and associate company. So for that point, you have to. I mean, when we are deciding pricing, you can add that part.
Okay, sir. Thank you.
Excuse me, sir.
Yeah.
Yeah, sir. In this model paper, in the computation of the income tax liability of the company, if there is treasurable interest income, we will say there is amount. So can we deduct WHT, sir?
No WHT on treasury. Treasurable interest income is not subject to EIT.
WHT, no?
No.
In here, interest income from treasury bill, 4 million.
No WHT. We did this discussion in the lecture, right?
Yes, sir. Yes. I have doubts, sir. Like in the previous act, sir, can we
Previous act, yes, that's what to say. Previous act under the act number 2006 is that is called not withhold tax, called notional tax credit.
Notional.
Right now we don't have a primary market, they are deducting tax. Yeah. Now that primary market is not recognized under this act.
Okay, so okay. Thank you, sir.
So it's done previously, if I summarize, I think I don't. It's not important to you. At the primary market, there are primary dealers, right? Just like and security. You know that Unalocious, what they company. These are the primary market thing. They can buy that treasury bill bond and at the issuer. Okay, we cannot directly buy from the central bank. First thing, I'm the primary market dealers. They are purchasing that one. They are reselling. At the primary market, previously they have deducted tax. Right, primary market transaction was exempted under the previous act. Right now, there is no such exemption. So therefore, the deducted tax under secondary market, that buyer can claim that tax credit, but it goes as notional tax credit. They are not paying that tax, but they can claim the credit. That was the setup prior to 2018. Now it is no more there. If there are treasurable interest, subject to tax, but there is no withdrawal. Same thing. Okay. Then shall we wrap up?
Okay, sir. Thank you.
Prashant, Bandara, Vinsar. Is Teja there? Hello?
Excuse me, sir.
Yeah. Yeah. I can hear you. Hello? Hello?
Yeah. Can you hear, sir?
Yeah.
Yeah. Sir, we'll say, sir, if we are invoicing for a person in USD, we'll say in foreign currency, and if we receive that amount in LKR terms, sir, is it VAT exempted or zero rated, sir?
So yeah. Reason is, first thing you have to check whether that particular service is rendered in or outside Sri Lanka. So if that service is rendered in Sri Lanka to a person in Sri Lanka, even we are invoicing in foreign currency, and even we are receiving in foreign currency, it's not a zero rate supply. Right? So right now in Sri Lanka, right now we don't have that dollar transaction, possible dollar transaction, but there's some company can still do. Right? Say a direct exporter, they can pay in dollars to another direct exporter, but it is not a zero rate supply. Zero rate supply, so there's that how it says it says services rendered by person in Sri Lanka to a person in or outside Sri Lanka to be consumed outside Sri Lanka, earning in foreign currency remitted through a bank in Sri Lanka within 6 months from the date of invoice, it is treated as zero rate supply. Right? But if it is received in foreign currency, LKR, it shall be treated as exempt supply. If we invoice to person outside Sri Lanka in foreign currency, but we receive in LKR, it is exempted supply. Intention is to bring foreign currency to Sri Lanka. Them to claim that zero rate is state, foreign currency should be bring to Sri Lanka.
Sri Lanka. Okay, sir. Thank you, sir.
Then okay, then shall we conclude? Hello. Right. So then thank you everyone.